Adrian, fantastic to have you back. Thank you for joining us. Adrian, first, let's start with your take on global liquidity. Do you think last night US Fed clearly has quelled and allayed all fears of a monetary tightening?
Good morning. I really feel a lot of sympathy for Chairman Bernanke. I think he's done an excellent job in explaining that the central bank in the United States will continue to use QE if that's necessary because the economy is weak. And as the economy recovers, they will take away QE and they will taper. I think the base case now is that tapering starts in September. Markets have got used to the concept now. And I hope that over the next couple of months that we spend a little bit less time listening to the Federal Reserve's speeches every other day and really just sort of focus on the fact that the US economy is recovering and it needs less help.
So Adrian, what will this mean then for fund flows for emerging markets? Because we've already seen funds pulling out of emerging markets, especially India, the minute Mr. Bernanke mentioned the word tapering.
Yeah, look, don't pretend it's just India. We are seeing redemptions out of emerging market bond and equity funds. There's no evidence that India's actually got a disproportionate amount coming out of it, but India does have one big structural problem, which is its current account deficit. If you run a current account deficit, you need to attract money every day, and if you don't, your currency is weak, and that's clearly what's panned out here. We see US interest rates at 10-year going to 3.25% by the middle of next year. I think this will continue to put pressure on EM fixed income, and EM fixed income funds are very likely to see ongoing redemptions. And so that's going to be negative for emerging markets. Effectively, what you've got here is an externally imposed tightening cycle on economies that were slowing down anyway. So India, ironically, is actually suffering a little bit less than other emerging markets. If you look at Indian corporate bond yields, they've actually been drifting lower year to date. And the short rates are also lower year to date, despite what the RBI did at the beginning of this week. So India is slightly less impacted than other EMs that I'm looking at, such as Brazil, Turkey, Indonesia.
Adrian, the key success story for Q1 numbers has been IT. An underperformer like Infosys has delivered, and TCS again has managed to surprise everyone on the upside. Do you think Indian IT industry has a long way to go, and because of weakness in rupee, we could be staring at some more good days?
Yeah, look, as a relative call, I find Indian IT very interesting. It is difficult to play an improvement in developed economies using emerging market equities. Indian IT has the largest share of revenue coming from the United States that you'll find for any EM sector. It's also a major beneficiary of the weakness of the rupee. So we are very keen on Indian IT sector.
What about consumption as a theme, Adrian? Because we've seen the FMCG space at least being on a tear in the last couple of trading sessions. Do you think this trend of investors actually vying for safety and therefore betting on defensives is going to continue for some more time?
Yeah, I mean, I wouldn't call it consumption, because when you say consumption, it makes me think about autos or, more discretionary items. People want defensive earnings, so the staples fit in with that in terms of the FMCGs. It's also important to understand that we have a leveraged buyout transaction going on with Heinz in the United States. We've seen M&A activity in breweries in Thailand. We have M&A activity going on in the supermarket space in Thailand. We've seen Latin American M&A activity. And in the case of India, we have the parent company trying to buy out minorities of one of the FMCG companies. So I think there's two things at work here: a desire for more defensive earnings in EM, but also there is very strong demand, primarily driven by mergers, acquisitions, consolidation.
That's a great point, that if Berkshire Hathaway is a value house, if they are looking for a leverage buyout, that clearly means there is value in the FMCG space. Adrian, what about banks? Reserve Bank of India is desperately trying to protect the rupee. In order to do that, they have sucked out liquidity and the short end of the market has got hit. Do you think this is a good strategy?
I think the Reserve Bank has handled this reasonably well. We've seen a very sharp reversal in flows from an expectation that Japanese QE would lead to an ongoing flow into emerging markets to really a sharp reversal of that. Some central banks have burned through a lot of FX reserves trying to protect the level of the currency. India has used up some of its FX reserves, but it's been reasonably modest and it's allowed the currency to weaken. One of the ways that you can speculate is through the leads and the lags on imports and exports. And I think what the RBI has done is targeted those quite specifically without giving the signal that it's tightening monetary policy. And that signal would come through if it had actually increased the repo rate.
What about banks then, Adrian? Because, I mean, few of the earnings which have trickled down, even the big boys from the private side, they too have had persistent asset quality concerns. Do you think this is a trend that we'd have to live with?
I think what you should expect to happen with these banks is the share prices will remain under pressure, probably relative underperformance near term as investors switch into IT, switch into more defensive earnings. But it's important to remember what's happened with interest rates in the last 12 months. They have been drifting lower. You've seen corporate bond yields drifting lower. There's a bit of a modest monetary stimulus going on in India. Now, normally monetary stimuluses have a lag of a couple of quarters. We also will have less fiscal drag in India as we finish this calendar year. So I would be looking for banks to come a bit lower, and then I'd be buying into them with the view that as we exit 2013, the data coming out of the banks will be improving.
But in general, would you like to avoid banks which have a wholesale franchise and you would focus on banks which have a retail franchise without getting into specific names? Maybe you can drop a hint there.
Look, the short-term trade is to avoid those that are wholesale financed. But if we begin to see some stability in the rupee and that the measures the RBI put in place are successful at reducing volatility, then I think you probably should look back towards some of the wholesale banks with the view that monetary conditions remain a bit easier than they were last year.
But in general, is it time to still avoid growth-related or economy-related stocks? Because it is pretty evident that the rate of marginal change will be disappointing. When we started the year, expectations were high, but because of rupee and the macro environment, GDP could recover, but the recovery may not be very substantial.
The way I'm thinking about this is I want to buy into the more cyclical sectors maybe towards the end of the third quarter of the calendar year, because I do actually expect India to do better at a macroeconomic level in the final quarter. And it's very helpful that currently the consensus is moving in the other direction.
Since you're talking about that, Adrian, a whole host of brokerages have downgraded their growth estimates on India. The finance minister himself came a few days back and said that, a 6% GDP growth is what he expects to see for FY14, 7% for the next fiscal. What are your own projections? Do you think we'll manage to scale to that 6% mark?
Look, I think the economy, particularly if you're looking at annual numbers, if your first couple of quarters are relatively soft, then 6% is going to turn out to be a good result. But let's put this in context. It looks like we'll be lucky to get 2% GDP growth out of Brazil, probably less than that out of South Africa, maybe 3% out of Turkey. China is clearly slowing down. So, as an asset allocator, India's growth slowdown doesn't make it special.
Adrian, I guess everyone in India is wondering that what would be the turning point when it is time to move out of these safety, defensive and consumer names and time to revisit growth stocks, because markets have been debating that. Unfortunately, that turning point has not come in.
No, but my view is it's towards the end of this quarter that we're in, the third quarter.
What would be that data point or indicator which you're tracking with the magnifying glass, which will tell you that it's time to jump out? When you say end of the quarter, what exactly would you be tracking there?
So look, equities are leading indicators, right? They discount things. So when the data's changed, usually the equities have already moved. So the two things that we're looking at is that interest rates on average have come down in India despite what the RBI did at the beginning of this week. And the fiscal drag at the beginning of the year was very severe. You had increases in diesel price, you had a very austere budget. The level of fiscal drag as we exit the year will be less. So it's those two macro factors which lead to a forecast of a modest acceleration in growth. And then we buy into these deep cyclicals, which are being sold off heavily at the moment as people revise down GDP growth.
Are you also building in any upside from monsoon and with what could happen before elections? Typically, pre-election spending, it tends to pick up, especially in rural India.
Yeah, so I think that you will always get fiscal slippage ahead of an election. It doesn't matter whether you're in the United States, in the UK, in India. So we do have a food security bill, which potentially is a rural stimulus. I think the other thing I would highlight with regards to agricultural production is it looks like we're going to have bumper crops in India with a good monsoon. We're clearly going to have a bumper crop in Central Europe. And it looks like soya production is very good in the US. So there is a good news story out there, and food prices should be relatively benign globally, and agricultural output and many of the EMs will surprise positively.